Hey guys, welcome to another Level Logic video. Today I'm going to cover the newest statistically based indicator, which is called the Wick Report. Like the other indicators, this has embedded data analysis, which I've done external to TradingView to help give us even more bias in confluence with the rest of the indicator suite. So I'm going to cover the theory and data behind it and how I like to use it. But just before we get into it, I just wanted to show you an example of what we're going to be talking about. So here we have, I'm looking at the daily on a 5-minute time scale. Okay, so we've opened up the day here. We've created this small low wick, and then throughout the day, throughout Asia and some of London, that wick has stayed small as we've built up this internal liquidity. And this being such a small wick, it had a low chance of staying that small. So what the data shows is that it's likely that the low wick needs to be bigger than that. Okay, so that means that we need to at some point come back to make this wick larger, which means we need to exceed the size of the current wick. Okay, so this is our current daily low. In order to make a larger low wick, we need to come down and then come back up so that we then have a larger wick that's more in line with the data. So I'm basically using it as a target and a draw on price because it statistically hasn't made its low yet. So firstly, let's go over where the idea originally started and how a candle actually forms. Okay, so it's got to create firstly we have our open, and then we've got to create at some point the highest point of the interval and the lowest point of the interval, which creates our high of the candle and our low of the candle. Okay, and that's also how we create our wicks. So one day a few months ago, or a couple of months ago, we had a daily that opened up and started moving up and left no wick on its low. Okay, so all through Asia it was building up and we had no low wick formed. So I basically wanted to see how likely that was to remain that way for the rest of the day, that we leave a daily candle without a bottom wick. And it turns out it's incredibly unlikely. Okay, it's like 95+% chance that we are not going to leave the daily low like that without a wick. All right, so what's more likely happening is that this candle is actually going up to locate its high of the day. Okay, so as we've come up, price is tracking like this all day. Okay, at some point we find where the daily wants to make its high. Okay, so let's say it's found it here. Okay, so now that it's done that, it's now going to start coming back down in reverse, okay, and leave behind its high of the day and form its top wick. Now, we may close here, all right, and that's the daily candle, but this is an incredibly unlikely scenario because we haven't made this low wick yet, all right? So what is more likely is that we need to reverse at some stage, come all the way back down past the daily open, find wherever the low is, and then come back up to form a more in line with the data, a wick that's more in line with the data. Okay, so price would come all the way down past the open, find where the low is, and come back up to close, so that we end up with a candle that looks more natural, more typical, right? And that's what the data shows as well, okay? So we could have come back up above the open. It could have been a bullish day. But you see what I mean? We still need to create wicks that are more in line with the data at some stage. So based on that, what I wanted to know after that is, well, okay, we just did a study of the wickless, but what if we came down at the open and just formed a tiny wick and then went up? Is it the same scenario? Are we likely to hold that tiny wick, or are we likely to exceed it? And it turns out that for a lot of the small wicks and certain percentiles of wicks, we are likely to exceed them. So that's where the idea originally started, and that's what we built the new indicator based on. So now let's just look at some data of when the daily forms its high of the day or its low of the day based on whether it's a bearish or a bullish day. or whether it forms its high or low first. So let's focus on a bearish day first, and when it forms its high first. So you can see we've got some key times that stick out here. We've got daily open, we've got around London, and we have New York open 8:30, 10 a.m., which typically form the high of the day. Before then, later in the day, we form the low. Okay, so we're forming the high, we're coming down, and then we're forming the low later in the day. All right. So if we look at the distribution of that, again, same sort of thing. You can see these peaks that are sticking out at the key times for the high of the day, the red, okay, before we then come and make the opposite side towards the end of the day and then close. So if we look at the cumulative probability of that, okay, 18 is our open. As we track along, once we get to around London Open, we're now crossing that 50% threshold. So that's saying that 50% of the time we have already made the high of the day. Okay, and as the day goes on, it's more and more likely that we have made the high of the day. So come 10 o'clock, there is a 90% chance that we have already made the high of the day if the day is going to be a day that's tracking down, that's bearish, right? This is all the same for a bullish day, but just flipped, okay? So you can see now we're focused on the low of the day for a bullish day because we want it to go up and we want to find the low. So 18, 3, 8, 9, 10, all sticking out again. Same with the distribution, okay? And same with cumulative, all right? So they're just opposite. Okay, so we'll get back to that high of the day, low of the day data in just a little bit, but let's just cover the actual indicator and then we'll get back to that. So here is what the indicator actually looks like, okay? In the settings, I've currently got it on showing both the high and the low wick, all right? But typically when I'm actually using it for bias, I have it on auto. I'll explain that in a little bit. But basically, okay, so we've got both of them on, and what it's showing is the size of the wick. Okay, so 0.04% is the size of this low wick. What hour we are currently in? So we're currently in the 4 a.m. hour. Okay, what percentile this wick size is? So P30 means it's in the 30th percentile, which means that only 30% of wicks have a wick this small or smaller. Okay. Then you've got a probability to exceed, which is 73%. Okay, so that means at a 0.04% size and at 4 o'clock, there is a 73% chance that from here until the end of the day, we exceed the size of this wick and make it bigger. Okay, then finally, score is a weighting of the percentile and the probability. Okay, so it's basically combining both into one to give you a score. And so what you're looking for, if you're wanting to use this as a bias to get exceeded, you want a high score. So it goes all the way to 100. It'll never get to 100. Anything over 50 is pretty good. Anything over 60 is great. So you can see here we've got a 50, which is pretty decent. That means we've got a relatively low percentile and high probability, which means this is likely to grow in size, this wick, okay? Now up here you can see I've got a similar thing. I've got a high score and a high probability, but why am I not going to use that? Why is this not relevant to me? Well, because we're a bullish candle currently and we're tracking up, we're still trying to find our high. So this is going to constantly change because we're so close to the high, all right? So obviously when we're this close to the high, the wick's going to be tiny, okay? So this data isn't really relevant until we're lower, okay? And we've moved away from it. So typically what I do is I'll have the indicator on auto, which means that if we're above the open, I'm only interested in the lows, and if we're below the open, I'm only interested in what the high probability is, okay? So you can see here, like what I discussed in the start of the video, we've opened up, we've come down, we've created this small wick, and then we've tracked up all day, creating all this internal range liquidity. And once we're in London session, I can now see what the probability and the score is that we're likely to form the high of the day and then take this out towards the end of the day. Okay, so as we track along with the day, you can see I've got the daily candle over here so you can visualize it a bit better. But we tracked up all day, we found the high of the day, and then we came back down to exceed that wick that was too small to fit the data. And the high wick is now more in line with the data. Okay, so you can see here that the high wick is now 0.45%. It is P95, which means 95% of the candles have a wick this size or smaller. Okay, so it's well within the data. And there's only a 49% probability that this will get exceeded again by the end of the day, meaning from 10 until the end of 17. Okay, so really, really low score, 2.5. So I wouldn't be targeting this high to exceed this wick because it's now within the data. So if I overlay the cumulative data graphs on the chart, you can see as the day is tracking along, it gets more and more likely that we have formed our high of day or low of day. So here we are at nearly 5 o'clock and we're approaching 60% chance that we've either made the low of the day or the high of the day. Okay, but we don't know which one yet. So we need more data, and that's what this Wick report is giving us. So at this point, we have either made the low of the day, and that's set, and that's what it's going to be for the whole day, or we need to make the high of the day, and we're going to come back down, and we're just setting the high of the day. All right, so that's my choice. But with the additional data, I'm now seeing that we have a high probability that this needs to be a larger wick than it currently is. So it's more likely that we are at some point around this time or a little bit later forming our high of the day before we then need to seek our low of the day. If we also look at the other indicators as additional confluence as well, so here I've got C's set on the daily time frame. All right. And what C's has done is we've gone external to the previous day. So you can see here, one day, 50th external, which means we've crossed the median external high for the daily. Okay, but we haven't, on all these time frames, we haven't even registered a low yet. So all these time frames have opened up and we've just gone up, 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 and we're getting to higher percentile areas where it's unlikely that those time frames are going to go much further. And it's more likely that their highs are in or very close to being in. Okay, so with that being known, that you know the high's nearly in, and we haven't formed really any percentile lows yet, we haven't registered them, and we have this wick that is likely to get exceeded, it's a great bias to the downside. So in addition to that, we've got more and we've got hyper. So more is telling me that we've gone above the previous interval and we have some high probability opens to retest, and we're getting into high percentile extensions before that retest is likely to happen. So it's also likely that the high is in before this retest happens if it's going to get retested. And you can see the more dashboard is lighting up red for a lot of different opens to get retested. So that's kind of your first target and your first bit of bias to start a reversal. Okay, so if we get in something here, then we can hopefully get to here, by which case we can take profit or go break even. And then we've got hyper, which is showing us all this internal range liquidity with high probability, which is going to power your trade down as well. And then our final target can be the daily low wick, which, as we've just discussed, is likely to get exceeded. Now you can see that as we've exceeded that daily wick, on C's, we have now started to register on the higher time frames some low percentiles, all right? And we've now got a high daily wick, which is very unlikely to get exceeded. So it's likely that that was the high of the day, and we don't have much left in the day to go and take that out, all right? So that was a good bias to the downside from all of the suite. Finally, I'll just go over some of the settings in the indicator. So you can choose the 4-hour, the 12-hour, the daily, or the weekly time frame. They should all work with the same theory in how the candle forms. I have been testing and typically using the daily and had some good success with it. So I've just been sticking to that, but by all means test the other time frames as well. Box right extension bars, that just means how far this box extends past the current bar, so that the labels don't get in the way of the current price. Okay, look back, you don't have to worry about. Data values, so this is just what labels you actually want to see here. If you only care about the score, for instance, you can turn everything else off and just see the score and the size. Okay. Thresholds, so if you only want to see high scores, or if you only want to see high probabilities, then turn this on. So if I turn threshold for the score here, okay, 50, you can see it's on, but if I change this to 60, it will remove that wick, okay, because it didn't meet the threshold. Okay, turn that off, it'll come back on. Okay, wick mode. So auto means that if it is above the daily open and we're currently bullish, it will show you the low, okay, to target, because it means that we're tracking up and we want to get the low. And if we're below the daily open, we're tracking down and we want to come back to the high. So it's only going to look at the high wick if we're below the daily open. Both is pretty self-explanatory. It will show you both at all times. Bullish only, it will show you the low only, and bearish only, it will show you the high only. Okay. Typically, I have it set to auto though. I've found that to be the best. And then all in here, you can obviously change all the colors and stuff. Now, just a tip: where I tend not to use this is if we're constantly bouncing above and below the open level. Okay, so if this was our open and price is actually just going like this, right, and it's not really tracking one way or the other, we're just ranging above and below the open, then this indicator is not going to be good. Okay, it's not going to work well. And it's not really how it's designed to be used. So what you actually want is for it to leave a small wick and track one way and build up liquidity the whole day or the whole interval before you can come back and take that wick out. You don't want it to be indecisive and going up and down with the high and the low wick constantly flip-flopping around. Okay, so you want it to be creating that internal liquidity so that then you can take it later on. Hopefully that cleared up everything you need to know about the Wick Report indicator. If you'd like to use that or any of the other indicators in the suite, head on over to levelogicindicators.com and hope to see you in the Discord. Thanks.